I'm Craig Jeffery. I'm the Managing Partner of Strategic Treasury. I'm here with Mark O'Toole from OpenLink. Mark, why don't you just give a quick intro about what you do at OpenLink and what is OpenLink?
Yeah, I've been with OpenLink for nearly 11 years now. We're an enterprise treasury risk management software provider. At our core is our ability to be able to handle on a transactional level enterprise market and credit risk, and then the adjacencies to that, things like operational risk and regulatory reporting as well.
Excellent. So we are talking about risk visualization, that idea of putting into images, words, graphs, charts, ways to visualize what's going on and what matters. So we'll advance probably 2 slides. We'll just skip 2. So really what we're talking about here is, and when you think about risk, what is risk, the broader types of risk. So maybe you could explain what are some of the risks that treasury groups need to think about or concern themselves with?
Yeah, it's a good question. You know, certainly in the last couple of years, it seems to be a hot topic. You know, as Treasury starts to branch beyond just their typical cash management and treasury functions into broader areas across the organization, risk is becoming, you know, front and center into the management of that. And when people think about risk, they think about, you know, it can mean different things to different people depending on who you ask. So certainly from our perspective, we look at things like enterprise risk, market and credit risk, operational risk, regulatory risk, and compliance risk, and reputational risk, and then geopolitical risk. And how does one manage all of these facets inside an organization to be able to, you know, actively manage that? And from our perspective, I think where we differ in the marketplace is the ability to be able to do that in a proactive way and not so much a reactive way. And part of the challenges I think companies have had around being able to manage these, pretty much all of these broad categories, is to be able to get that data in a single place so that they have all the transactions and the data in one place to be able to look and analyze that data, be able to measure that data, and be able to proactively see where the riskiest parts of their organization may lie, in whether it's a market move in market prices, a counterparty failure, an operational risk, and even geopolitical risk, planning for you know, elections. You know, if companies aren't even looking at what implications to either party winning the presidential election, or if you're in Europe, whether you were based in Britain or in Europe, thinking about Brexit and what the implications of voting to leave the EU would mean, being able to take the data that you have and see how that type of thing, or those events, impact your corporation, and be able to plan for that and take active measures to mitigate the risk of loss.
Okay, so great. That was a good overview of the universe of different types of risk. So when we think about risk management, we think about what's the risk universe, or the potential risk potential, how big that is. And an organization typically has some sort of risk capacity which is smaller than that. This is the most risk or exposure that they can bear for cash flow or for a threat to principal or liquidity.
Yeah.
Then there's a narrower level of risk, which is the risk appetite. That's what's stated as here's the most that we're willing to bear, and we put policies in place. Then there's also this other smaller level of risk, which is really their risk appetite. You know, their what they're willing to bear.
Yeah.
That's smaller, because they'll say here's what I'm comfortable with. But when push comes to shove, people get a little concerned when it gets up against that real limit. So there's a stated, and then there's an actual level that's a little bit narrower. Any comments about that?
Yeah, you know, it's interesting you say that, because I think traditionally, you know, it's well understood within the banks, risk management and tools around that, and being very highly analytical around evaluating and measuring the risk. And I think within corporates, there's a growing tendency now to take the emotional out of a risk. So instead of saying, if you're you know, a food and beverage company and you've got large amounts of commodity exposure, for example, the general sense being that, you know what, I feel the market is going to go down and therefore I'm not going to do anything, or I might hold additional inventory because I think the market's going to go down or it's going to go up, and that can be a drain on your cash flow and your planning and your budgets, versus being analytical about that. So being using actual tools that removes the emotion for making those decisions so that you can equally measure the tolerance. So if you have a policy and you have a tolerance level between X and Y, coming up with a number of scenarios, whether it be around hedging or the tolerance and limits to that risk, you're taking the emotional feel out of that, and you're getting into a more analytical, proactive ability to be able to manage that risk.
I think that's interesting. That emotion plays into many organizations. They're expecting something to occur, or they're taking a position when they should be not taking a position. They should be eliminating risk or keeping it within the risk tolerance that they actually have. But a question I have for you on that is one thing that we see as a challenge in many organizations is, we know risk can have a bell-shaped curve, or maybe not so nicely bell-shaped, may have very long tails.
Yes.
And so there's an element of capacity. So the point here is, many people that aren't finance related or finance specific or trained tend to think of things, and here's an expected value, here's what we think, and they tend to think of small movements on either side, not what can happen if it's farther out. So talk about that as well. I mean, that's kind of like adding on to that element of emotion in risk management. What are your thoughts there?
Yeah, I guess more specifically around sort of visualization of risk and the ability to be able to sort of anticipate where those risks lie in a very understandable-like fashion. So, the ability to be able to, from an enterprise perspective, be able to analyze all of that data results in a lot of data and a lot of numbers. And I think when you look at multiple stakeholders across an organization that may be viewing that risk, you want, from a risk perspective, to be able to explain that in a sort of an easy to digest sort of way. So those stakeholders could be the Treasury Department, the CFO, the finance group, the supply chain, compliance, internal audit, etc. And so having the graphical ability to be able to focus on the things that are the riskiest in the long, the here and now and out over the 24 months, 38 months you may have exposure to. What are the things I should be focused on proactively? And then knowing that from a tool perspective, a risk management perspective, you have the numbers to back that up and be able to explain that. So if I have, like, for example, a value at risk number, so what does that mean, and how do I explain my VAR number change between today and yesterday? The ability to be able to show that graphically and see what is it we need to be focused on, what's impacting that change, is it new positions, old positions, options, exercise, changes in your P&L explained, market prices, volatility, etc. And be able to back up those numbers and be able to explain to a senior management team that you're proactively managing the risk and mitigating that risk, and here are the things, the three areas we want to focus on. But also, if you talk about tolerances, the ability to be able to put in risk limits, whether they be counterparty limits, instrument limits, portfolio limits, and be able to actively manage that. So let me know when I'm within 70% or 80% of that tolerance level. I'll certainly proactively want to know about that so I can head off in any sessions that may occur.
So how does that risk visualization helps display it in a way that might be more consumable? I guess a question I have is, sometimes people view risk as, finance people understand risk in more detail than maybe someone who's in executive management that didn't come from that background.
Yeah.
And so, the issue can come up, and someone's, maybe even someone from accounting says, we would have done a lot better if we didn't have this hedge in place. We lost money on the hedge. Which to someone in finance is sort of that's sort of nonsense. You're like, well, you don't have it there to make money, and hopefully, losing money is fine because you have that hedge in place to protect yourself against, moving outside the risk framework parameters you have. You want to keep it into not only within your risk capacity, but your risk appetite. So, so it's not. Sometimes people view it as it's an event. I teach people one time, show something once. How does risk visualization help continue the story and continue the training of the rest of management to say, here's what we're doing, here's why we're doing it, here's how it's working and is being effective?
Well, I think, that's a good example where, if you're a company, you're not just putting on one static hedge and hoping for the best. If you're doing it properly, you're doing dynamic hedging, and before you even do the dynamic hedging, you're if you're going to set your risk policy for the year or modify it during the quarter, you're going to come up with a number of scenarios and use tools to be able to see what the likely outcome would be based on market factors or external factors. And so between coming up with a number of options to do that, you come up with, okay, well, what's the most optimal one that sets is within the risk policy, the risk tolerance that we've set as an organization, and then how do we manage against that. And then certainly in terms of the output of that is being able to see visually your mark-to-market or your P&L explained and how well those hedges are performing. And of course, when it comes into graphs and pictorial views of that, heat maps, color codes, red for disaster, we need to look at that, and green for go. I mean, there's different ways to be able to pictorially or graphically show that. But I think the key is, on one level is the color code plus the graphs and where is that relative to our tolerance level is a good way to do that. And then the good news is that if you're doing it right, for organizations where the management might ask, well, what does that mean? It looks like terrible, that's we're all in the red there, is to be able to very quickly then analyze and drop down into those numbers and see what constitutes that so that they can see that in a more detail, so that the numbers are there to support that.
Excellent. So this is a question. So value at risk, cash flow at risk, potential future exposure, a couple different techniques for managing things. Pick one of those and explain how risk visualization helps the organization understand what you're trying to do.
Yeah, well, I mean, if you look at a sort of a cash flow at risk or any type of bar analytical like number, it's like how much could I possibly use over a given time period and at what confidence level. So you're going to be able to say and graphically show this is how much we could use based on current conditions in the marketplace. So it helps you from being less emotional and less reactive to an after the fact thing, and places more of a focus on proactive risk management so that we can anticipate a likely loss and where that likely loss could occur, and in what part of the business or in what type of instrument or in what type of asset class or with what particular trader or hedger or division of the company. So it gives you a bit more of the ability to pinpoint where those risks can occur.
Well, that's excellent. You see sometimes people see, oh, it's 1 in 20 likelihood that this will occur, and this is an unacceptable outcome.
Right.
And sometimes people just dismiss it as like, well, that's not going to happen. How do you know that's not going to happen?
But you don't.
yeah, you don't. And history may not be an indication of the future. Well, maybe it's 1 out of 20. Well, you got 2 of those events happening in your career at least.
Yeah, and we have sort of, we go a little further in terms of the analysis, so we don't just do baseline, we can get pretty sophisticated, but we have the, in opposite cases where the fat tail occurs, in other words, in the unlikely event, well, we've a 95% confidence level that we could lose X over a quarter or a period of time, but what if, a terrorist attack happened or a natural event happens, that becomes a sort of a fat tail black swan event. And so the ability to be able to also measure that in the unlikely event that something like that could happen, how does that impact the business, and be able to plan for that potentially.
Right, so long tails and fat tails, distribution curves, those can be really confusing and challenging for non-financial people, even for people oriented in finance or accounting. So risk visualization is crucial. Any final thoughts on risk visualization, the value to the organization?
Yeah, I mean, I think what we've certainly seen over the last sort of 17 to 18 months is companies that have a lot of, or have a renewed focus on risk and risk management, going from less of a reactive to more proactive. It's driven by executive teams, it's driven by CFOs, it's driven by the outside board members. How are we proactively managing that type of risk? So, certainly that's a sweet spot for OpenLink in our ability to be able to actually proactively report that kind of risk. That helps, improve margins and reduce costs across the organization.
I want to thank Mark O'Toole from OpenLink for talking about risk visualization. So thank you, Mark, for joining us.
Thank you. Thanks for having me.